Okay, here we're going to talk about problem 6.8, and it is identical, I think, in both the versions of the textbook, 15th and 16th edition. I think the 16th edition uses a different city name, which kind of goes to show you the amount of new changes that are made to these textbooks when they roll out a new edition every few years. That's part of the reason why I've kept the same edition the past few years, because it just seems like a big money grab for the folks. So anyway, let me tell you what the town name is in the 16th edition. It is called Sandy Beach. Okay. So Newtown had 9.5 million in 4.5% serial bonds outstanding. This was as of 12/31/2010. They had cash already of 509,000, and it's the only asset, and that was put there to cover the principal payment, the first principal payment. There aren't any liabilities. The serial bonds pay interest semi-annually on January 1st and July 1st, with $500,000 of bonds being retired on each interest payment date. And the resources to pay these debt service payments are transferred from the general fund, and the debt service fund lobbies property taxes enough to cover the principal payment. So the interest is covered by the general fund, and the principal payments are covered by levying real estate property taxes. Okay. So we're going to prepare the entries for both the debt service fund and the government journal, government-wide entries for these transactions in fiscal year 2011. So the first thing you got to do to help out is you're going to have to do the budget. And so you need to know how much interest is going to be transferred in from the general fund. So our semi-annual interest payment, you're going to first take your $9.5 million principal balance, multiply it by the coupon rate of 4.5%, then multiply it by half a year, or 0.5, to get your first interest payment of $213,750. Your second one is you're going to do the same thing, except you're going to subtract that first $500,000 principal payment you're going to make on 1/1. And this is going to give you your 7/1/2011 interest payment of $202,500. Okay. So when you add those together, that's going to give you your total total interest payments of $416,250. Okay. So that's going to help us prepare our budget, which is the first problem. Operating budget consists of estimated revenues of $121,020,000 and other financing sources equal to the amount of interest to be paid. Because remember, the general fund is going to cover the interest. So you're going to have to record here your estimated revenue, which is a debit, of course, from our multiple budget entries we've made over the semester. $1,020,000 to estimated revenue and taxes. $416,250. Remember, that's our total interest payment. Total interest payments we're going to make above, which means that's what's going to be covered and transferred in by the general fund. Total appropriations, that's going to equal our two bond payments, which are $500,000 each. So that's $1 million, plus the $416,250 of interest payments. The net of all those is our budgetary fund balance of $20,000. The government-wide entry, of course, since it relates to the budget, there is no government-wide entry. All right, so we'll move on to number 2. We're actually going to pay the debt service, okay? First, though, the cash to pay the interest payment was received by the debt service fund from the general fund. So you have to record that cash coming in. So you've got a debit for $213,750. That's the cash coming in for that first interest payment that we calculated up here. And you're going to credit other financing sources, interfund transfers in. Okay. The Government-wide entry, because you're transferring between funds that are both governmental funds, there is no government-wide entry in the government-wide journal or the governmental activities column, because all those governmental funds are inside of that one governmental activity. So kind of there's no adjustment there because it's between those funds. All right, the second part of the number 2 is you're actually going to pay the principal and interest. And there's the interest of $213,750, the principal of $500,000, and the total of those is the cash going out the door, which is a credit for $713,750. $713,750. Now, number 2, you are going to record this part of the entry in the government-wide journal, and it's going to look very similar, except you have already accrued this interest, and we're going to show you how this works in number 6. But remember, the government-wide journal operates a lot. It looks similar to a business, a for-profit business. So the reason you're not on this is a 1/1 entry, a January 1st entry. So the reason that you're not debiting interest expense here is because you've already accrued this interest expense as of 12/31/2010. Because remember, this is, the interest, the payments are due on 1/1 and 7/1. So as of 12/31/2010, there was a payable on the books for the interest of $213,750. So you're debiting that accrued interest payable there. You're debiting bonds payable, crediting cash for the same amount of $713,750. All right, number 3. This one's easy. Property taxes in the amount of $1,020,000 were levied, and they didn't make an estimate for uncollectibles. Okay, so it's all going into taxes receivable and revenues. A debit to taxes receivable current for $1,020,000, and a credit for the full amount, again because there's no estimated uncollectible, for $1,020,000. And the entry looks exactly the same in the government-wide journal. You're just debiting a different sounding account. General revenues, taxes, real property. Number 4 says this is the amount that was actually collected, $1,019,000. Okay, so $1,019,000, a debit to cash, a credit to taxes receivable current for the same amount. The entry looks identical in the government-wide journal. Debiting cash, $1,019,000, crediting taxes receivable for the same amount. All right, number 5. Cash was received from the general fund and checks were written and mailed for the July 1st principal and interest payments. You know what? Well, these don't give a date. Let me put that in the memo though here. 785. This is all happening on 7/1/2011. Let me change this to where it's where you can see it. Oop. And what's going on there? Let's see how that text. 7/1/1. Okay, there we go. Let me get rid of the bold too. All right, so these were all, let's see, 7/1/71. And these up top were 1/1. Okay. Sorry. All right, and these others just kind of happened. These in the middle of the taxes receivable, the problem doesn't specify a specific date because they occurred during the year. Okay. But number 5, all right. So number 5, we got to record the interest, the transfer from the general fund first, which is $202,500. Remember, we calculated that interest payment up here, And remember that the general fund is covering the interest payments of this fund by transferring money in. And so there you go, 202,500 of that interest payment up here that we calculated. So that's our first step. Again, because these are transfers between governmental funds, there is no government-wide interest. Now we're going to actually make the payment of interest and principal. And so you see $702,500 going out the door, which is made up of $500,000 of principal and $202,500 of interest payments. In the government-wide journal, it's going to look similar this time because, you know, we're in the middle of the year, so we haven't accrued any interest payable. We're just going to debit expenses here. Expenses, interest on long-term debt. Bonds payable of $500,000 and cash of $702,500. And so there's your payments. Remember, you had to make the transfer in first, then you made the payment of the interest and principal. All right, number 6. Adjusting entries were made and uncollected taxes receivable were classified as delinquent. At the fund level, you also closed out the budgetary and the operating statement accounts, okay? So first, taxes receivable. Again, when you're doing your Smithville problem or whatever, this is a common mistake that I see. In here, all you're doing is taking whatever the current balance is of this account, which is taxes receivable current. You're taking that balance and you're zeroing it out because the problem is essentially saying all this is now delinquent because we're at the end of the year and we still haven't collected it, okay? And so you just have to go back up to all of your accounts, or go to your pre-closing trial balance is a good place to look in the Smithville application. You have to go up and find the balance, whatever the current balance is, which in this case is $1,000, and it's a debit balance of $1,000, and you have to zero it out. And so to zero that out, of course, you credit it for $1,000. So we're crediting taxes receivable current, and we're moving it all to delinquent for $1,000. Okay. So there's your entry there for that part. And the other part of this entry, when it says adjusting entries, remember that we will be recording. We don't really accrue payables in the governmental funds. We do in the government-wide journal, the governmental activities column. Okay. And so again, this is how we have to do the same thing we did above. We have to come up with our new principal balance that's that we have currently, that the 1/1/2012 interest payment is going to be based on, multiply it by the coupon rate by half a year, and that gets us $191,250. Okay, and that's an expense in the current year on the government-wide. So we're debiting the expense, and because we're not going to pay the cash out the door until 1/1/2012, we are accrued interest payable on long-term debt of $191,250. Okay. Let's see. Looks like I have some account titles that are making the the balance is not pull over correctly. I apologize. Or not making the account numbers pull over, which is not really applicable for this assignment, but it needs to work for if this is used for the Smithville assignment. So anyway, so just like we did with the taxes receivable current, you need to also do, when you're closing entries, you need to also take your pre-closing trial balance. Even though this one up here is not technically considered a closing entry, you're just doing a reclassification at year end. But you need to take a similar process whenever you are working these problems and you get to the closing entries. You need to go to your pre-closing trial balance, which is going to show you all the entries that relate to a given account. So appropriations has a credit balance of 1.4 million and change. Then that in your closing entry, that needs to be your debit for $1,416,250. Okay. And you're doing similar things with all of the other accounts. You're closing your interfund or estimated other financing sources, your estimated revenue, estimated tax revenue, and all that. There was only one entry to that, which was recording the original budget. This wasn't one of those problems like you've seen in other places where the budget was amended mid-year. So this is basically just a reverse of the original budget entry up in number 1. Okay, these amounts though are made up of several entries throughout this problem. So let's filter and let's see kind of what our pre-closing trial balance might look like here. And we have a credit balance of $416,250. So we're going to debit that, okay, for other financing sources, interfund transfers in. And you are just going to do that for the revenue account, the tax revenue account, the bond interest account, the bond principal account, because remember, this is a governmental fund. So when you're paying down principal, it's treated as an expenditure. And your fund balance restricted is just your plug, which nets all this out in these kind of this non-budgetary entry here. This is your budgetary closing of your budgetary accounts up here. I know it's confusing because they happen to hit their budget perfectly, you know, on all accounts. So this is your the net of those is what your credit is going to be to fund balance restricted. And so this is you know, what you have. This is problem 6. Sorry there, got distracted. This is problem 6-8, and hope this was helpful to you.